So, guys, welcome back. If anyone is suffering from major hay fever, let us
Oh
know
yes,
in the
yes.
chat below. Myself and Shiv are definitely going through it ourselves. But we're looking forward to doing a quick market update for you guys actually this. So we're going to be about 25, 30 minutes on today's episode, and we're going to be talking to you about what's going on with mortgage interest rates, what's happening with inflation, and one of the things that we might actually touch on as well, if we've got time, is what to expect potentially in the upcoming elections, which are not so far away right now. So, look, why don't we get started and get straight into it? Shiv, why don't you take us through a little market update of what's happening in the market at the moment when it
Right
comes to
now.
inflation and mortgage interest rates, and how is it impacting people?
Yeah, totally. Okay, so what we've got to realize is that when we talk about mortgage interest rates, inflation, all that kind of stuff, it's all driven ultimately by inflation. Inflation is the first thing, and inflation at the moment has been coming down steadily. If you remember, I think it was what last year, the year before, it was 11.1%. What that means is every year prices were increasing 11.1% year on year. So just so that we're clear, let's say you buy something for you buy a car for £30,000 this year. Next year, it will be like 33,300 or whatever. It's going to be 11% more than it was this year. And of course, we expect things to increase in price every year a little bit anyway. There's, if you remember those 10p sweets, sorry,
Yes.
10p crisp packets, no longer 10p, now like 20p. But if things increase in price a little bit is fine. That's stability. But when it increases by 11% in one year, that's quite a lot. So it increased quite a lot. It's then started to come down steadily. And this year we were kind of like, well, what's going to happen now? And since January, so I've got it here. January, the inflation rate was 4%. It then went to 3.4%, 3.2%, 2.3%. And currently in May, it was 2.3%. 2.3%, for those of you who are watching who know this, is that the Bank of England's inflation target is 2%. So 2.3% is pretty much bang on the money. That's where we need to be. And so what's going to happen now is we are let's say what has happened is whilst the inflation rate has been coming down, what should have happened is the interest rate should also be coming down, but it hasn't. The interest rate has stayed at 5.25%. We went up and up and up and up, 5.25%, and it's just stayed there. And there's only one interesting reason. In fact, Dipesh, do you know a reason why interest rates have stayed at 5.25%, even though inflation has been coming down?
I don't know, so I'm well looking forward to
Right.
it.
Here's the answer is that as soon as interest rates start to come down, people are going to be like, oh, let's go and spend. Like good times are here. And if people go and spend immediately, then guess what happens to the inflation rate? It starts to go up again. So what's happened right now is inflation rate has come down, and the Bank of England is saying we're going to hold our interest rate at 5.25% so that everyone gets a very clear message, and that is that the good times are not here right now. Because as soon as we get the message that the good times are here, people are going to start spending, and we need to keep inflation rate at two. Well, like I said, the target is 2%. It's currently 2.3, so it still needs to come down a little bit further from where it is right now. So what's going to happen, I think, is that over the next couple of months, we're going to see the inflation rate continue to come down from 2.3, come down to 2.1, maybe 2.2, 1.9. And as soon as it's around that level, we'll then see the Bank of England base rate being held again for another couple of months, 2, 3 months. And then what I think is going to happen is once we see that there's been stability in the market, the inflation rate has reduced to the right level, the interest rate is now at this level, and as soon as it starts going, the inflation rate starts going south of 2%. That's when we're then going to start seeing the interest rate starts to decrease a little bit. And what does that mean? Why are we even talking about this in the context of property? Because this is all economics. A higher interest rate, 5.25% as it is currently, it means that the mortgage interest rates are going to be higher as well. As the base rate starts to come down, the mortgage interest rates are going to come down as well. So what we are expecting over the next year or so is for the mortgage interest rates to slowly start to creep down. At the moment, you can get, for example, a 5-year fixed rate mortgage for about 5%. But we'll
Yep.
see that I think over the next 2 years or so come down to probably around 3.5% in about 2 years' time. But we will wait to see what happens. Now, what's happening there, Dipesh, is people are saying to themselves, well, hold on, if the mortgage interest rates are going to come down, with mortgage interest being high, it's expensive to borrow money. If the mortgage interests are going to come down, why don't I just wait for 2 years? I'll wait for 2 years. Mortgage interest will be at 3.5% instead of 5%, and then I'll get a better return on my investment, right? This is a great idea.
This is a great point actually, and I think this is something that I really want us to cover on, which is what does it mean for potential investors today if
Yeah.
they were to take advantage of what's happening in the market? And is there a way for them to take advantage of what's happening in the market right now when everything does seem like, the bank saying, here's a clear message, good times are not here? So how does an investor that's savvy take advantage of a good time that's not there for the majority and the mass?
Perfect. So the first way to answer that question is if you are a savvy investor, if you're looking to take advantage of the market, you have to do the opposite of what everyone else is doing. You have to do the opposite of what the news is telling you to do. You have to do the opposite of what the Bank of England is telling you to do because they're trying to, well, they're talking to the mass people. And the mass people are the herd. They're going to go up when it goes up and down when it goes down, and they're going to ride the whole roller coaster. What we want to do is when the prices are here, we want to go, let's get in because we know that when the prices are lower, everyone else is going to be getting in. So it's going to be much harder to get those deals there. If we can get in right now, even though the prices are here, we can negotiate the price to be a bit lower. There's less competition, so it means we can negotiate the price. And I think ultimately, what is the way forward, the trick here is to say, I'm going to buy now because we know that the interest rates are going to come down. So I'm going to buy now, knowing that over the next few years, the interest rates are going to come down. And the reason I'm going to buy now is because I know, one, I can negotiate the price right now. I can't negotiate the price in 2 years' time because everyone's going to want to invest at that time. So I can negotiate the price. That's the first thing. And the second thing is that, so let's say I bought a £150,000 house for £140,000. I've saved £10,000. So £10,000 in my bank. Then I'm going to make, let's say, for example, a 5 to 10% increase on the value of the property every year in my capital growth. And let's say that we're saying that it's going to go from 5% to 3.5% in 2 years. If you hold off buying for 2 years, that's 2 years, £150,000, 150, let's say 10% to make maths easy. At 10% is 15 grand you'll make in the first year, and then another roughly 15 grand in the second year as well. So you've now made 30 grand worth of extra return because you invested today, not to mention that you got the 10 grand discount because you bought it at 140 because you could negotiate. So you made £40,000 extra over waiting until 2 years. And let's just put that into perspective. People are saying, oh, well, I'll wait until the mortgage interest rate is 3.5% instead of 5%. Every year, you'll save £1,000 on mortgage interest. So over 2 years, you'll save £2,000, but you'll make 40. This is what people don't see. People just see the £2,000 saving.
Okay, and I'm gonna play devil's advocate because I know what you're talking about, and obviously
Yeah.
both have the same viewpoint on property as well. So now let's take the perspective of someone who maybe isn't as bullish on the property market. So
Yeah.
what are the chances of that property increasing in capital value consistently? And
Yeah.
what if the market downturn? Talk to me about that.
Yeah, perfect. So what we do know is that property prices over the long term continue to increase. They continue to go up. Now, what does the long term mean? It could be 5 years, it could be 10 years, it could be 20 years. The point is, if you buy a house now and you hold it for at least 20 years, it will be up on where it is today. It will not go, it will very unlikely to go down on where it is today. And you know this because just think about the house that you bought or think about the house that your parents bought, however many years it was ago, 5, 10, 20 years ago. It's worth more today than it was then. Very few people are in a position where they bought a house and it's now worth less than when they bought it. So that's the first thing to say. In terms of what happens if there's a market downturn, this is the best bit. If there is a market downturn, and let's say you bought the house for 140, it was worth 150, and the market goes down, it's now worth 140. So you bought the house for 140 and it's worth 140. So guess what you're getting? The rental income on a monthly basis, and you've got in the market today instead of 2 years from now, which means that even though the rental income is lower than it will be in 2 years from now, you're benefiting from that every single month. You're getting all this return, which adds up to, I think, off the top of my head, somewhere between £3,000 and £5,000 a year. So £3,000 to £5,000 a year you're getting on per year for 2 years. That's £10,000 of rental income, plus the fact that you bought the house £140,000. It's worth 140, so you've not lost anything there. So you've still made your return. So in the worst case scenario, and the market kind of goes down, you're safe. If the market stays flat, which is probably more likely than the market going down, then you've made money. And if the market increases, which I think is exactly what's going to happen, and in fact, I suppose I'm premature here, but let me come into why I think the market is going to go in an upward direction. This is the conversation we were talking about with the elections that are happening right now. Okay, so it's no secret, Dipesh, for a lot of people that are watching this, this is exactly what they're going to think. They're going to think conservative government, good for business, good for growth, good for property investors, all that stuff. Labour government, bad for business, bad for growth, bad for property investors. That's what people think. So, and of course, right now we're in a predicament where we know more than likely we're going to have either a Labour government or a hung parliament. We're not going to have a conservative majority, we think. So the likelihood is not going to have that. that means that people are thinking, well, maybe now's not the right time to invest in property because growth is going to be lower, businesses are going to be lower, investments going to be lower. It's just going to be, I don't want to say it, but stagnation. Like Labour government, we're not pro-business, we're kind of pro-redistribution. That's what's going to happen. But here's what's actually going to happen. The Labour government are going to say, well, yes, rightfully, we want to have more redistribution. So we're going to make sure that the people at the bottom end of the market, i.e., the people that live in, for example, Leeds and Sheffield, have more money in their pockets. Well, what does it mean if they have more money in their pockets? That means they can pay more money for rent. Interesting. So what do you think is going to happen to rents? They're going to increase. The other thing that's going to happen is a lot of people who are thinking like this are going to say, oh, well, you know what? I've been a landlord for 10 years or 15 years or 30 years, and it's just not worth it anymore. Labour government are going to come and screw me. So people are selling off their houses. What happens if they sell off their houses? The supply of properties decreases. If the supply of property decreases and the demand for properties is still the same, the price of properties increases. So this is very counterintuitive to what people are thinking is going to happen. I think what's going to happen with the Labour government is we're going to have property prices increasing and we're going to have rents increasing. It's going to be, I believe, good times for people that want to invest in property as long as they're investing in the right areas. If you're investing in high-end properties, city centre locations of London, for example, I don't think you're going to have that same kind of impact. But if you're investing in the kind of properties that we invest in, I absolutely think property prices are going to increase, rents are going to increase, and I think they're going to increase pretty quickly. We're in 2024 now, middle of 2024. I'm fairly certain by the time we get to 2026, we're going to have this, in the next 18 months or so, we're going to have this rapid increase in prices and rents.
What's your rationale behind why you believe that Leeds and Sheffield will continue seeing maybe more of a compounding growth over the coming few years versus London not experiencing as much of that growth?
Yeah, and this all comes down to the relative price of property compared to earnings. So let's say, for example, someone earns, let's talk about Leeds and Sheffield first. Someone earns, I don't know, 30 grand and the price of property is 150 grand. So it's 5 times their salary. In London, someone earns, let's say 100 grand, they earn double. Amazing. How much is the price of property? It's not 500 grand, is it? You're looking at like £1 million for a property. So it's 10 times their salary. So that means that the relative.
I was just going to say, just for context, comparing like-for-like properties. So the type of properties that we're looking at in Leeds and Sheffield are typically 2 and 3 bedroom houses, maybe 4 bedroom, depending on the amount of money an investor wants to put in. So if we use 3 bedroom as an example, if you look for a 3 bedroom house towards the centre of London or the very close surrounding boroughs around London, and we Harrow as an example, you're looking at a 750k minimum if you're looking in a semi-decent.
And you're saying Harrow, Dipesh, but Harrow is from London. It's not like 10 minutes away. The areas that we buy in Leeds and Sheffield are literally a 10-minute drive from the city centre. So when you are in the city centre of London, you drive 10 minutes. Where do you end up? Like not very far. And the prices of houses there are looking at like a couple of million. And like I said, the earnings are still 100 grand, 150 grand for people. So I think the reason why the prices in the areas that we buy in are going to continue to increase way more than they are in London is just because a good way of saying it is that the prices in London are capped. They're capped by how much people can actually affordability. They can't afford them because they're already having to pay 10 times, 15 times their salary for the mortgages. And as we know, for most people, you only get a mortgage of about 4 or 5 times your salary. So it's just, you're going to have a really massive deposit, and that's going to be like £1 million deposit, then you can buy the house. Whereas if we're looking at Leeds and Sheffield, it's like, actually, you don't need that kind of £1 million deposit.
Yeah, I love that. So thanks for clarifying that. Now, let's go back into the bit around the politics and Labour potentially coming in. Let's just say that Labour don't come in. Let's say that there is Parliament and the Conservatives carry on as well, because that's the opposite of what people might be fearing. What do you expect to happen if Conservatives stay in power?
So Conservatives have had a rough ride, I think, over the last few years. They've had, COVID and stuff. They've had to deal with all of that kind of stuff. And then obviously the problems that come out of COVID, which is supply shortages and all this kind of stuff. So they've had a rough ride. And I think what they need to do now is probably sort of build back their name as the party, because they know that Labour are going to play the other part. Labour are going to play the redistribution card. So they have to build their name as the party that is pro-growth, pro-business, pro-investment, and they're going to create and like I said, unlikely scenario, but in the scenario that Conservative comes to power, they're going to create a hub where people want to invest in the UK again, because we need to get our economy going. We need to kickstart this economy. So I think ultimately what's going to happen is, if we do get Conservatives in power, we're going to have way more investment in the country. We're going to have way more investors that want to invest outside into the other areas which are cheaper for them to invest in. Way more focus on business and less red tape, less bureaucracy, proactiveness, all of that kind of stuff. And I think ultimately it will be a good time, as long as the Conservative Party can convince people that they are pro-business. The alternative, so we've talked about Labour, we've talked about Conservative. The alternative, which is probably the likelihood, Dipesh, is we'll end up with this hung parliament. Hung parliament means we're going to have like two parties that are in power. You know, Labour, Conservative, maybe Labour, Lib Dems, who knows? But the point is, whenever there's two people in power, nothing happens. If you look back at history, at the times where they've had hung parliament, generally speaking, we sort of dilly-dally, we kind of like stagnate. And when I say stagnate, I mean your wage growth is going to stagnate, business is going to stagnate. But I've just explained that because of the way that the Labour Party, who are going to be probably the majority, they're going to organise themselves. House prices are going to increase regardless, and rents are going to increase regardless. So I think house prices and rents in the areas that we're going to increase, in the areas that we invest in, are going to increase regardless of whether we have a Labour government or a hung parliament. But I think what we need to be careful of is that if you have a hung parliament, your wages might take a bit of a hit, in the sense that I don't mean they're going to decrease. I just mean that they're going to increase at a slower rate. And the reason why that's important is because we always talk about, can you save your way to wealth? We always say, oh, well, you know, I make 50 grand, I can save 10 grand a year. Perfect. I put 10 grand away, 10 grand away, 10 grand away. If your wage is increasing at this level, but your house prices are increasing at this level, if you don't increase in houses, if you don't invest in houses today, you'll just never will be able to invest in houses, because they're just going to get more and more. The distance between your wages and the houses are going to get more and more. So I think that that's a really important thing to note, is that although if we have this hung parliament, house prices are going to continue to increase, wages are going to continue to increase at a much slower rate. And as a result, I think people are going to get into the market. They're going to want to invest in property, because where else are they going to put their money? If businesses are going to kind of start to, like, not stagnate, but, you know, not increase as quickly as they used to, people are going to say, well, I don't want to put my money in the S&P 500. I don't want to put my money in the FTSE 100, because they're not increasing as quickly as they used to for the last 10 years. So people are going to then start to say, well, where else can I get the returns that I used to get before? Property is a good example. And the reason why, we've already talked about previously, Dipesh, in property, you get two returns. You don't just get one return, you get two returns. You get the rental return and you get the capital growth. Plus, in property, it's a tangible thing. You know, unlike the stock market, where we don't really know what the hell is going on, in property, we know. We buy a house, we put a tenant in there. We understand mentally, we just understand the concept of rent. Someone pays rent, and their rent will be £1,000, and the mortgage will be £500, so there'll be £500 left over, very crudely. So people understand how they're going to make money in property. So it's a tangible asset. They can touch it. It's very easy to understand. It's not complex. Like, the reason why we got into the global financial crisis is because there's loads of complex stuff going on that no one understood. It's also inflation proof. What that means is it increases in line with inflation. A property is one of the items that is taken into the basket when we calculate what inflation is. So that means that if inflation is increasing, then the house prices are going to be increasing as well. So there's lots of good reasons why property is a good asset class to invest in, certainly over the next kind of decade or so, whilst we have this new parliament government in place.
I love that. And the one thing I want people to take away from this as well is actually, whether Labour come in, whether there's a hung parliament, whether Conservative stay, it actually doesn't really matter in terms of your viewpoint from an investment standpoint, because
Totally.
there is opportunity no matter what is happening. And it's not about one parliament or one position of power being in parliament that then says, oh, investors aren't going to get a return. It's actually about finding the nuances to kind of work within the investment space that allow you to create that return, irrespective of who's in power.
You know why this is, Dipesh? You know why this is? Let's just simplify all this. Guess what politicians have? They have investments. People, have you heard the saying, turkeys don't vote for Christmas? Multiple investments. Turkeys don't vote for Christmas. Politicians are not going to vote for their own investments to decrease in value. So what we should do is, the people that are in power, we should copy what they're doing. And they invest in the stock market, and they invest in property market, and they diversify between the two. guess what? For a lot of people that we talk to, they already have the stock market investments. They don't know that they have them because they're tied up in pensions, and they call it a pension, but that's investing in the stock market. You need to now diversify into the property market, and certainly if you're looking to increase your returns, in diversify into the northern property market, because that's where we're going to have these increasing rents, increasing house prices, and the most amount of increase is going to be in the northern cities.
Love that. Final thing to finish on for today, then, because we are perfectly on track, and I want to squeeze it in there as well. Why, if anyone's considering investing, why is now? So today is the 5th of June, 2024. Why is today or this month a great time to get into either starting the investment journey, or maybe you've already got a portfolio? For those of you that are listening and you want to add to that portfolio, why is June 2024 a good time to get started?
First reason is, and we know this, the best time to invest in property was 20 years ago. The next best time is today. You cannot go backwards in time. So today is the best time. The second reason is we're about to have elections. Off the back of elections, people are going to make their decisions. And as a result, right now, we're saying, well, hold on a second. We don't have the information yet. We've just talked about the fact that it doesn't matter what happens. Investors are going to win anyway. But for people who don't know what's going on, they're going to say, well, we'll wait until the elections are out of the way, and then we'll start to decide what we want to do with our money. If you get in now, you can negotiate prices. If you get in afterwards and everyone else is in the market and there's no negotiation of prices because everyone's trying to get the same deals. So I think that's really important. The third thing, and this is what we see all the time, Dipesh, is that people come and talk to us about investing in property, because obviously we help people to buy and build property portfolios for themselves. Generally speaking, they engage with us somehow, whether it's a phone call or whether it's just watching our social media content, watching this live, for example. And then it's usually like 6 months later, 7 months later, that they actually are ready to buy a property. And so I always say to them, like, yeah, what did you do in those 7 months? Nothing. Like, you just waited because you became more familiar with the idea of, okay, this property thing is a good thing, good idea, whatever. Well, if you did it 6 months ago, if I said to you the capital growth in that year is 15 grand, the capital growth in that 6 months is 7.5 grand. You've lost 7.5 grand by not doing it at that time. You waited for 6 months. So I think to a lot of people, now's a really great time to get involved because of the elections, but you need to get involved as soon as you possibly can, because house prices continue to increase. They don't go downwards, generally speaking. If they continue to increase, you're losing out because you're buying house at more and more expensive price. The ability to negotiate is going away because we're getting closer and closer to the elections. And these are all the reasons why I think June 2024 is the absolute perfect time, because guess when the elections are? July 2024. So we need to have this and get involved before, so that we can get involved. I suppose the way I'm trying to say it is we get involved before everyone else does. We get involved before the mass market gets in. If you want to be wealthy, you've got to do the opposite of what the mass market is doing. And I tell you something, in July and August and September, you're going to see a massive increase in the number of people that have demand for property, that want to buy properties. And so therefore, I think we're going to see an increase in prices starting then. So yeah, that's why June 2024.
I love that. And thank you so much for clarifying that as well. So for those of you guys that are listening, I'm going to drop the website for Lifestyle Property into the chat, into the comments of the Facebook live. So you are more than welcome to go and check out what we do, how we do it. If you want to have a call, if you're thinking about investing and you're not quite sure about how to do it by yourself, and you want our help and expertise to get it done, book a call with us. You'll speak to one on the team and we will help you in that journey. We'll help you get a property. One last thing I will add about why June 2024 would be a great time to get started or to add to your portfolio is because generally the process of buying property, including a refurb and then getting a tenant put in, takes about 6 months. So if you want to have that property in your portfolio where a tenant is income, this is the time to get it done, because if we start in June, you will have a tenant paying you rent for Christmas. What better Christmas present could you give yourself?
One last thing, Dipesh, to mention: if people are looking at this and thinking, "Oh, I might be interested," of course they can get in touch with us and they can speak to one of the team. That's a really good way of doing it. If they're not ready for that and they're just like, well, I'm just starting off on my journey, just trying to feel around a little bit more. On the 19th of June, we're going to have a webinar, and that webinar is going to give people a bunch of information about what's going on in the market right now, why now is a good time to invest, and just give you at the moment we're just talking about it. This is going to be like graphs that represent what the information is, and also how does our service work, what do we do, and all of that stuff. So if people are interested, then they can register for that on the 19th of June. Just drop a comment or a DM to one of us and we can help you do that as well.
Perfect. Guys, otherwise, this has been another episode of The Property Perspective. Thank you so much, Shiv. Thank you so much for joining and jumping on as well. And we'll see you guys
Perfect.
on the next one.
Thanks so much. Cheers, guys. Bye bye.